If building robust, math-based algorithms is the foundation of future trading performance, it still remains pointless without proper execution. Being able to consistently translate theoretical trading rules into accurately executed trades is easier said than done. From over-optimistic assumptions, to IT failures, to hidden market imbalances, way too many quirks can keep a winning trading system from generating that solid track record promised by its backtests. Yet, as crucial as it is to quantitative trading, this topic of algorithmic replication is almost always overlooked or ignored. The fact of the matter is that a lot of drama comes in the picture when live, real money trading is involved, but it does not mean that you should become a passenger when it happens. So in this video, I will be showing you how to anticipate and minimize the most dire issues that are the likeliest to cause a gap between strategy modeling and actual execution. And especially, I will explain the best practices to mitigate the drama of live trading while maximizing your replication quality throughout the life cycle of your trading systems. Let's go. Algorithmic replication can be defined as how well your actual trading results mirror those modeled in your forward tests. Perfecting trade execution in order to maximize that replication quality is the real-world challenge that you will have to face as a professional quant trader, and it is a two-sided problem. Flawless order placement is obviously where rubber meets the road, but before that, a preliminary step needs to be taken to ensure that the simulated performance goals are realistically attainable. Regardless of whether your system is profitable or not, wrong assumptions are the main factor of future deviation between a theoretical strategy and its actual execution. Correct assumptions are almost impossible to thoroughly compile from scratch though, without some extensive hands-on trading experience gathered over many years, be it yours or that of others. So let me save you the cost of learning by yourself the hard way, and let's review the 3 ways that your backtest cannot be replicated and how you are setting yourself up for some massive disappointment. In no particular order of importance, the first way that your strategy cannot be executed in real life has to do with unrealistic logistical constraints. Imagine building an intraday system on a 24-hour market such as Forex or cryptocurrencies, but having a full-time job and not having a script running on a VPS in place. How exactly are you going to execute your trades when you sleep or are away from home? What is the expected performance impact on your expectancy of repeatedly missing random trades? But 24-hour markets are not always the worst logistical Rubik's Cube to solve. What if you build an ETF system using US ETF providers, but are being classified as a retail investor in Europe? That means that you will be stuck using European proxy ETFs to trade your system, ones that trade on exchanges which opening hours do not overlap US trading hours, leaving potential execution gaps for hours every single day. How will trading these proxies affect your performance versus trading the real thing? As you can see, all of these issues need to be thought through and ironed out before hitting those buy and sell buttons, because these constraints can literally negate your strategy's future life success altogether. The second way your strategy will be hardly replicable is because of a gross underestimation of liquidity-related issues. And contrary to popular belief, liquidity constraints tend to affect retail more than institutional traders despite their much smaller order sizes. This is mainly due to the fact that retail does not have access to the myriad of liquidity pools and private venues that institutions do through their prime brokerage, and particularly when it comes to executing block trades. Retail traders, on the other hand, are captive to whatever venue their brokers will route their trades to, and this poses a few issues. As we know, retail is addicted to making a quick buck and is always looking for shortcuts to patience and actual work. Shortcuts that lead them to such nonsense as scalping currencies or trading penny stocks, all the while using BS unquantifiable concepts or drawing on charts. Visiting a couple of trading forums or the plethora of widely popular scam trading channels on YouTube will confirm as much. Invariably, the same crowd gets slaughtered and spit out by a margin call, and this is where it stops for most of them. The problem is when the same traders finally wake up and decide to get smart about it, and genuinely attempt to build a comprehensive and quantified strategy. In many cases, they will still fail to replicate it in live conditions and still lose money, and most of the time, it is due to a misunderstanding of liquidity. This can take several forms. Let's start with slippage. On thinly traded markets such as penny stocks, wrong assumptions of liquidity layering is often the cause for dismal replication. You need to realize that thinly traded securities only display the last traded price on the chart, but they do not show where your order can actually be filled at each price level. And for all you know, there might have been just 10 shares traded at that 65-cent price level that you fed your model, when your model assumed that you filled 1,000 shares. In reality, filling your entire order would have probably required to bust through the offers on the order book to eventually get an average fill price of 72.5 cents, thereby destroying your assumed expectancy. To make matters worse, There is very little way to model liquidity accurately, unless you take a widely exaggerated margin of error, which in almost all cases will negate your strategy altogether anyway. Next pitfall. Making wrong assumptions about spreads can also prove lethal to your replication. This is particularly the case on OTC markets such as Forex or cryptocurrencies. Spreads vary a lot on these markets, and feeding your model with price data based on the bid alone will totally distort the quality of your system's modeling. For example, for FX crosses with a wider spread, which is almost everything outside of the euro-dollar, the cable, and the dollar-yen crosses, assuming that your buys will get filled at the bid might result in many non-executions when the ask price never made it low enough. Still, your model will assume that it did, and it will necessarily overstate your winning edge, especially when we know that the best trades are often those that work immediately, with very little recoil through the limit, if at all. Conversely, misjudging the impact of spread will routinely result in missing being stopped out. Imagine being short pound yen, with a spread of 1.2 pips. Now let's say that the bid price rises to 1 pip short from your stop loss before collapsing. Under these assumptions, your system will not pick that you were stopped out by 0.2 pips. Not only that, it will also assume that you made a killing on your short when the market tanked thereafter. So where am I going with this? All of a sudden, you will find yourself with a huge replication gap between a real trade that lost money and a model that tells you that you made a ton. Now repeat that mess over 4 or 5 trades per year and you can imagine how your replication quality will look at the end of the year. Not gonna be pretty. Moving away from liquidity now to finish this section about what assumptions can go wrong. Let's take a look at executable price data. This time, we're talking about whether or not the data that you're modeling on is factually executable. And here is a dirty little secret that only trading veterans know about. Believe it or not, this problem affects even the most liquid stocks, including the most liquid ETFs such as SPY. Because stock market spreads are very thin and price data is normalized, you would assume that modeling on the official price data is as safe as it gets. Well, I have bad news for you. That environment too is flawed and will lead to erroneous assumptions that will come back to bite you in the ass sooner or later. That is because, as I said it previously, retail does not have access to all trading venues. The official price that you're seeing in the data provided by your vendor is typically the composite price, compiling a large subset of the most liquid trading venues. But it does not mean that these prices were traded on those venues that you have access to as a retail trader. And no amount of so-called smart order routing touted by your broker fixes that either. Sure, most brokers such as Interactive Brokers, TradeStation, or Charles Schwab give you access to multiple venues, but their array of available trading exchanges is still limited even if diversified, and this subset still comes up short to the full amount of liquidity pools compiled in the official price. And while this is true, the executable price discrepancies will not be even close to being as bad as they are for penny stocks, they are still imperfect. Let me show you a real-world illustration in the case of SPY. This is the daily chart. Now look at the composite range for that session, and now look at the New York Stock Exchange only range for that same session. See the difference? That is what I'm talking about. Seems insignificant at first sight, but it does make a massive difference over several years of system modeling, because it can and will lead you to assume execution when no such thing was ever possible in real life. So once again, even if it turns out to be less favorable to your backtest, make sure to use the appropriate price feed from the start. That will spare you a lot of frustration and disappointment when real trading gets involved. So now let's assume that you have ironed out all of these potential quirks and that your system is modeling a realistic backtest. You think you're on your path to riches? Well, think again. Many more things can and will go wrong. This is where contingency planning comes in. Let me give you the top 5 mishaps that will mess up your execution plan even if you have made the correct assumptions when designing your system. And I'll also tell you how to overcome them. Number 1. Limit pinging. This one consists in the price touching your limit, but bouncing immediately off of it, leaving your order filled either partially or not at all. At this point, you have 2 choices. To either wait and pray for the price to revert back to your limit and eventually give you a complete fill, or to buy immediately at market. The problem with waiting is that at this point, you have lost control over your trading plan because you should be in the trade, and you are not. To make matters worse, as you will see with experience, the best trades also turn out to be those that work right off the bat, meaning without inflicting much drawdown, if at all. So what should you do? This is actually not a guessing game. To answer that question, you must be both quick and have a thorough quantitative knowledge of your trading system's key stats. The rule of thumb to making your decision is, you should always remind yourself of what your current position should be, according to your system's trading rules. In this case, you should be in the trade already. Yet, you are not. So your default decision should be to buy at market as soon as you find out that your limit got pinged but not filled. However, there is a reasonable room past which you would not want to buy at market anymore, and that's where the knowledge of your system should step in. Let's assume that your average gain per winning trade is 1.25%, with a standard deviation of 0.35%. We know that by definition, your best gainers are going to be making well north of your average gain. So what I am doing, and feel free to adjust it based on your own experience, is to set myself a limit past which I will no longer buy at market. In my case, I use the average gain plus 3 standard deviations. Let's take a numerical example to make the countermeasure easier to grasp. Let's say that you initially entered a limit buy for 100 shares of XYZ at $10. The tape hits $10 but immediately shoots up, leaving your order only partially filled for 26 shares. So according to the rules that I just described, I would therefore buy the remaining 74 shares at market up to $10.23. Past that price, I would give it up and instead raise my limit order from $10 to $10.23. Fairly straightforward, but a very powerful process when you're caught in the live confusion of catching an unfilled order. Now let's move on to our next potential execution issue. Number 2, shadow fills. This one is directly related to the price data feed discrepancies between trading venues available to so-called retail traders that I talked about a moment ago. Let's take the case again of a buy limit order to keep things simple. This quirk entails that the official composite tape will register a spike low that is higher than the one actually executed. Basically, by picking up our previous example, it would mean that the official tape registers a low at 10.02, yet you did receive a fill at $10 sharp. So now, you find yourself with a live position that your system does not know you are holding. That is essentially an algorithmic free lunch, whereby you find yourself holding a profit that you're not supposed to be holding. So what should be your response here? It's actually easy. You should immediately sell at market whatever amount of shares were executed, book that profit, and place again your initial order. That way, you remain compliant with your system's rules, yet you are pocketing some free improvement on your replication quality. Next up are number 3, missed signals. This can happen for a number of reasons, be it human error, an emergency that kept you away from your desk, your computer's power supply frying up, a power cut, an internet outage, a server failure, your data provider's API crashing because it was changed overnight without notice, etc. As you can tell, I'm speaking from painful experience. Whatever the origin may be, in this situation, the outcome remains the same. You did not place the orders that you should have on time. And now the market is moving without you. So what should you do when your systems go back online? Well, first of all, you need to take a deep breath because you are in for a brutal trade reconciliation session. Now, I'm not gonna lie, this is not gonna be fun. But whatever you do not try to revenge time the market from here. What will happen is that some trades will have hit your theoretical entry price only to shoot back in profit without you. This is inevitable, but also, some will have punched through those levels only to be in theoretical negative territory when you pick them up. So what you need to do instead is to calmly go over each one of your missed orders one by one. Do not hurry, the worst is behind you anyway, and trying to speed fix everything up is useless at this point. Your entry timing for the session will likely be a wash anyway, and the only thing that you will most likely achieve by rushing it is to compound the problem by making trading mistakes. So as I said, take each order one by one, apply the average plus X number of standard deviations rule of thumb that I explained earlier. And in case you are adamant about knowing the impact of the session's issues, then by all means have at it and calculate your cost of opportunity after the fact. But do not focus on that when trading. Your only focus at this time should be to achieve the correct positions with the correct allocation and perfectly mirror your system's theoretical portfolio by the time you're done. Moving on to number 4, repainting signals. This often can happen due to bad data from your quote provider, or whenever a large dividend is paid out of a stock that you traded and the data failed to be back adjusted accordingly. At this point, there's nothing you can do. All that you should know is that your backtest is likely also affected by this flaw in data set. So if even when including these rare errors your strategy remains profitable, then there is no reason not to adjust your current live positions for what the system has repainted, no matter how frustrating it is. The simplest course of action then is to robotically operate the adjusting set of trades at the next market opening and be done with it. Also, remember to note how much, up or down, your track record was affected because of this issue. And finally, number 5, deal stocks. Now what is a deal stock? A deal stock is a stock that is being targeted by a takeover or a merger of some sort. This will usually cause the stock to suddenly gap up and then levitate as the deal is being completed, and hedge funds pull some arb trades on the remaining deal premium. This is particularly the case with all-cash deals. The behavior that it triggers in the target will often mess up momentum-based strategies by fooling them to signal an opportunity, when in fact there is little to nothing left to make money on since the deal is about done. And now, the stock will basically remain inert for a few months until the deal is consumed and the stock gets delisted. Should you get a false signal on one of these stocks, it means that your own database is out of date and you should retire that given taker from your trade candidates. Now notice how I said your own database, not your data vendors. That is why reviewing the merger and arbitrage activity is such an important step in my daily routine, a routine that I described in depth in this video. So once your database is updated, you should rerun your model and start fresh with the correct signals for the day. That is the only way to solve the problem. Remember, most data vendors provide data without much intelligent scrubbing. That job is yours, and you should never take any data provided to you for granted. Data management is a huge part of quantitative trading, even if it is very unsexy and almost never talked about. As you can see, even with a successful trading system, there is a world still separating you between theoretical and actual trading results. That is why you should always make very prudent assumptions when modeling your strategy. Always err on the side of being too conservative. You do not need to overcomplicate the process. Bundling the negative impact of commissions, slippage, spread, and trading errors can be achieved by factoring in a single variable into your system. Be creative about it. Make it take the form of a dollar amount per trade, a percentage of your instrument's daily range, or a percentage of your equity per year, etc. The limit is your imagination. Keep in mind though, that factoring in execution slips will likely have you discarded a lot of the strategies that you previously believed were profitable, and that's fine. You should not trade strategies that are on the statistical edge between profitability and unprofitability when traded live anyway. Trust me when I tell you that to succeed long term in this game and overcome all the issues in your way, you will need a fat edge, certainly not one tied to some ultra precise scalping. That crap will not hold in the real world. And to finish, I really hope that you now understand the crucial importance of your own bookkeeping and performance tracking. In order to ensure proper replication quality, your job is not just to trade. You will also need to be your very own back office, your most attentive scrutinizer, and especially, you will have to be able to transform your broker's account data into useful information, to be able to analyze where things went wrong, where you gathered over replication, and what processes might need to be changed in order to achieve algorithmic execution excellence. I really trust that this video opened your eyes to this massive side of real trading. There is a reason why nobody on social media talks about these intricate processes, and it's very simple. No matter how you might get impressed at them, the truth is that they cannot trade better than you do. In fact, most do not trade at all, and for those very few that actually do and can prove it, there is a lot more going on in their track record than just some guy hammering buys and sells on a computer like you are shown in these bogus trading videos. The track records that I publish are the product of grindingly difficult background work that actually makes trading itself an afterthought sometimes, and I want you to prepare yourselves mentally for that reality. Trading is an unforgiving, multifaceted business, one that will teach you to be your staunchest critic and one that will push you to a level of professional excellence and work ethics that will change you as a human being, with many qualities readily transposable to many other detail-oriented industries. So keep your head down, think forward, be methodic, and you too will be part of those few who manage to beat the game. I'll talk to you in the next video.